Hey traders, welcome to Charts and Coffee. Hope everyone had a great weekend. Get ready to kick off what should be anything but a boring week as we go into the first trading day or the second trading day, full trading day after non-farm payroll. We continue to deal with, what does the Boeing strike mean to the manufacturing jobs that we saw were lost on that NFP report on Friday? What is the storm affected Southeast in terms of impact on that jobs number? And even that extreme reaction to expectations that the Federal Reserve would cut rates in a far more aggressive manner, that definitely got unwound on Friday. But the initial reaction was, oh my gosh, we need a 50 basis point cut. Things have settled down since. It's not leaning towards that more extreme rate cut scenario for this week, November 7th. So remember, the FOMC is on Thursday, not Wednesday this week. And then moving out to the December 18 meeting, we're at mostly expecting a quarter point cut. So that's what the expectations are in terms of November and December's meeting. And ultimately, look, there is an interesting thing because people ask, Rog, why do you follow the Fed Watch tool as closely as you do? And here is why. Now, part of it I can tell you is looking back and using the Fed Fund futures for the better part of my career. This is something that I've looked at now for over 2 decades. And whether that be looking at now the Fed Fund futures contract was created in 96 or 98. I'm trying to remember. So, roughly just over 20 years ago, more than that, right? And what this futures contract is the same way we would trade gold or the S&P or crude oil. And then there's a delivery month associated with those commodities or with those contracts. The same thing goes for the Fed Fund futures. Obviously, we're not taking a deliverable, but what we're able to do is speculate on the result of each one of these meetings, which is listed across the top. So every one of these contracts is based on the date of the decision. And Jerome Powell and the Federal Reserve know that this is a very popular way to measure expectations. So it's really not a one-way conversation. As much as Jerome Powell and the different Fed members' words and data will set this up, set the scene for whether or not we expect a hold or a hike or a cut. It's equally a bit of a broadcast to the Federal Reserve to say, look, this is what we expect. This is what we priced in. And if we don't get it, there's going to be an adjustment that has to be made to whether it's treasuries, currencies, or the indices. So this is very much a two-way street where there was, and I think I've talked about this before, folks say, well, why does the Federal Reserve have to even care? Well, back in Q4 of 2018, Jerome didn't care. He actually, back then, I was looking at these just as I am now, and the expectation was for a hold. And that was pretty well broadcast. And Jerome in Q4 hiked. If you all remember that 2018 December hike. And then what ensued was the swiftest sell-off we've seen in indices. It was at the time until we had the pandemic in 2020. That's the degree to which when the Federal Reserve deviates from these expectations, from what's expected and priced in, that's the kind of reaction. It's fairly violent. And a very young Fed chair did that. Jerome Powell had just newly gained the throne in the Federal Reserve. He was Superman at the Hall of Justice, and this was his first major decision, and some would say his first major mistake. That's why we keep an eye on it. So in the meantime, we continue to hold the lows that we put in on Thursday and Friday. Nothing new. Obviously, the sell-off on the 31st, a couple things we could say about that sell-off on the 31st. Is that necessarily a reflection of any kind of election or Federal Reserve decision? Or was that end of month? Was that maybe some profit taking? And remember, in this world we live in of, for the most part, the vast majority of traders are momentum traders. I'm not, but when you think about what drives psychology, it's very much momentum. Higher highs tend to beget higher highs, lower lows tend to beget lower lows. Momentum feeds on itself. And at the end of a month, is it unusual for profits to be taken? When we saw, for the most part, the month was up? Probably not. Is it unusual for the momentum of, think about what has to happen to realize a profit? It's a sell. And like I said, the selling can beget more selling. And that's where we find ourselves. We have that end of month sell-off, more trick, less treat on October 31st. And we are now going into a week where we're going to find out who the next president is. We're going to find out what the makeup of Congress is going to be. And most importantly, we're going to hear from Jerome Powell. The rate decision itself is not the big deal. It's, what does the rate statement say? And how does Powell sound, right? Does this sound like a Federal Reserve that's committed to rate cuts into 2025? Because that's where, if you take a look out into January, out into March of next year, as clear as the picture is for November and December, especially December, since November's here, the picture gets very unfocused for early next year. And that's a lot of what we can see happening in what's going on with bonds. Bonds are not concerned about the Federal Reserve not cutting in November, December. They've already priced that stuff in. What they're looking at now is, gosh, 3 months from now, November, December, January, they're looking at, say, February. Do we have clarity into the March meeting? Do we have clarity into more cuts or not? And bonds would have to say, maybe not, right? Because yields continue to go up as bond futures go down. And that's again, another important thing about where we sit right now. Gold continues to be one of the best trends. I want to continue to find opportunities in gold. The volatility has been a little frustrating. We've had 3 different positions in gold, 251 calls, 253 calls. They've all hit different levels of potential target or risk management, which is fine by me. But the follow through has been a little tougher to come by. So I want to be patient, and I needed a lower low to get into gold. I'm actually surprised how much lower a low I do need before I can get back into GC or GLD. Another thing that I'm looking at is financials. Now, when we're looking at the S&P, when we're looking at the NASDAQ, when we're looking at the Dow, remember, not everything has to be focused on the indices. If there is strength in a particular sector, and I'll be going into the top tier outlook newsletter today, we'll get that out to everybody, but I'll be going into that topic. If it's not the indices, what sectors, as we go into early November, have withstood the sell-off at the end of October? And as we look ahead, remember, election or even Federal Reserve discounting doesn't happen the day of. It happens usually weeks ahead of time. So most of what we would consider election trades, or I prefer to look at it as election trends, those are positions that are already open. Those are positions that are just waiting for the ultimate result. And that means if those positions are on, the size is there, the price action is there, and the trend should be visible. And we'll talk a lot about those. But financials tend to be probably not just big banks, by the way. Also, regional banks are probably some of my favorite places to look right now. That's related to the Dow, related to the S&P, and some of the outperforming sectors that we have right now. And that's really probably where I would say it would make the most sense, preferring to be in the sectors that are outperforming. Not necessarily, I'm not concerned about where the S&P or the NASDAQ is going to be at the end of this week, but I am far more interested in where some of the sectors that are already showing signs of strength, were already up in October, positive, and are already showing signs rolling into November. That's really where I want to be. As far as this morning, I do get these questions. What am I looking at today? Ultimately, there's a few things that we're gonna look at, and I think one of the biggest mistakes traders tend to make is there's a belief that there's always going to be a NASDAQ or S&P trade every day. And I don't believe that to be true. I think there's always going to be something related to those indices, but not necessarily the indices themselves. But a few things to take note before we start the day. We're still at or around that previous session close, right? Now, there's all sorts of lines in the sand. And lines in the sand are really sentiment levels that tell me whether or not the general mood of the market's bullish or bearish, right? Just how are people feeling? And the previous session close is one of those important levels. Another one I'll look at is the anchored volume weighted average price. Another one that I'll look at are the dots, the propulsion or top tier dots. But the previous session close is one that doesn't need anything really fancy. I mean, the anchored volume weighted average price is something anyone could anchor. Make sure you anchor one pre-market and one at the bell. The other thing is, if you are looking at structure, this is a neutral environment. All right. This is very much a neutral environment. And ultimately, please keep in mind that if we have a neutral environment, no one's really got an edge at all. And that means that if we stay above the previous session close, I'll give a slight nod to the bulls. If we get below the previous session close, I'll give a slight nod to the bears. And so ultimately, a lot of clarity pre-market. No, we'll see how things shape up as we go through the clearing, the first 30 minutes of the day. All right. Let's see. Check it in from Nepal. Hey there, Jean. Wow. Hope that I don't even know what the weather's like in Nepal right now. I've seen photos. It's beautiful. I hope you're having a wonderful time. All right. Let's see. So thanks, Jean. Thanks for the check-in. JR says, if the bond market sees a sell-off, will that affect stocks? I don't believe so. And here's why. JR, thank you for the question. I don't believe so. Here's a really great example. Bonds are up, which means yields are down and equities are down, or they're struggling to gain some strength. The notion that bonds and equities are positively correlated just isn't necessarily true. The idea that a higher yield environment automatically means that equities must sell off, or that a lower yield environment, slightly lower like we have right now, means that equities should rally, just isn't in sync, because bonds are not trading and moving based on today. They're usually moving. And again, I'm using a rough estimate. I don't know exactly, but if you look at the behavior of bonds historically, you look at bonds year after year, and you juxtapose, say, the S&P against the long bond or the NASDAQ against the 10-year, you'll see that, for example, yields started to drop as the bond market rallied in June of this year. Well, think about what happened 3 months later, our first rate cut. So here's where the bonds are not about today. The S&P is about today, or at least a very, very near future. There's a lot of proximity to today's or this week's events in the S&P. Bonds are way out in February. So thank you for the question. I don't see a positive correlation, and don't take my word for it. Please don't. Question what you hear. Bonds are in a downtrend. The S&P hit an all-time high not but 2 weeks ago. So clearly, they're not on the same page, right? So every now and then, like a broken clock that happens twice a day, right? Bonds and the S&P will look like they're correlated. But unless that correlation can be seen again and again and again, session after session, or you step back and look at a daily time frame and see that the long bond futures are moving like the S&P futures, they should be a positive or sympathetic correlation, then there really isn't a reason to think that this is a harbinger to weakness or strength in the S&P. And that's the way I look at it. Thank you for that question. All right, gang. And by the way, we do a lot of different kinds of futures and macro type analysis. By the way, what's macro? Macroeconomics. And if you Google it, right, you'll see that basically macroeconomics talks about three main pillars: the jobs, growth, inflation. Are there lots of other data points? Yes, but I would not put them necessarily directly in terms of being a macro look. There is the macro lens type look, but please don't confuse a macro lens type look, a bigger picture look. Don't think that's actually going to supplant macroeconomics. The Federal Reserve doesn't take a macro lens view. They're looking at data. They're looking specifically at data around jobs and inflation. Those are two mandates. Growth is not necessarily, you know, growth is not necessarily an issue in terms of this Federal Reserve. Jerome Powell's pretty much dismissed a lot of times different growth implications. So those are things that overall, when I step back and look at the picture of the macro versus the macroeconomics, macro would say the election's a big deal. Macro would say, you know, fill in the blank, whatever headline, whatever news is driving psychology would be the big deal. And I just don't subscribe to that. I don't find it to be as consistent with actual price movement. And that's what we have to always use as our litmus test, right? Is the thing moving in the way that we think it should be based on whatever the analysis is, right? Okay. Next up is, let's see. Hey there, Chris. Good morning. From Vancouver with heavy rain. I appreciate, helps my groggy brain. Chris, thank you so much. It's early, and I appreciate your time. Awesome. All right. Let's see. Question on Dell. Sure. All right. Let's open up this daily time frame. All right. So Dell's got probably an interesting 2 month, maybe, yeah, about 1 or 2 month. Well, here's what I want to show you. Below, breaking below, 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 and then all of a sudden, the transition's beginning here. Green candles, trend, and above that white line. And this is the line I'm talking about, this white line right there. Okay, those dots, a series of dots. So all of a sudden, we're seeing green candles, a trend, and we're trying to get above, all right? Not super successfully, but certainly trying to stay in an uptrend and moving higher. Is there a trend here? No. Would I be bullish? Sure. Sure. Is there a major reason to put this on the watch list quite yet? I would say no, but it's looking as bullish as it's looked since July. Next up is gold. All right, so let's take a look at GLD. I've been trading GLD actively in the Sector Secrets Mastery. It's probably one of the best trends that I see. And do I want to get in there again? Yeah, I do, but we need a whole lot lower lows to do it. All right, we need a whole lot more selling to get to the zone where either I'm waiting for a mean reversion, which I'm frankly really not, which would be in here, or I'm waiting for the daily price movement range in there. So I need lower lows, and at that point, I'll get long calls, as we have done many times over the past few weeks. Has IBM pulled back enough? Well, it depends on the time frame, right, gang? It's not just as IBM pull back. I mean, if you're talking about pullbacks, that's the weekly time frame. And I'm not ruling out IBM as a weekly time frame buy somewhere around $200. That's a weekly trend. As far as the daily time frame goes, we've got to think about time frames, gang. As important as it is to talk about the symbol that we want to get into, we've got to talk about the time frame, because the structure on different time frames, bullish, bearish, neutral, is going to be different, right? So the slice of psychology, think of time frame as a slice of psychology. Think of time frame as what dictates how long potentially the trade could be on. So when I look at the weekly, there's a potential pullback conversation to be had. When I look at the daily, it's not a pullback conversation at all. It's actually a broken trend that's gone into chop. So now I question at what point will we see oversold support? And that's what I'm waiting for now. At what point can we find oversold support? And would I be long? Yeah, I would look at it this way. What preceded the chop was an uptrend. And I'm always going to favor continuation. I'm never going to presume reversal. Continuation is far more probable. And that's what I would look at there for IBM. All right, last question before we call it a morning. SOFI. All right. SOFI. And again, I need a pullback. Earnings were pretty good. Remember, gang, in this particular show and with this particular trader, I'm never going to be long at new highs. I need a pullback. I need a pullback. Most traders are going to buy new highs. Most traders, investors love new highs. That's probably 90% of how the markets function. Traders, especially retail traders, buying at new highs. And there's been so much said about Berkshire Hathaway. I tweeted a little bit about this weekend. There's so much conversation about Berkshire, about how much cash Buffett has, et cetera, et cetera, et cetera. Do you think for a moment that Warren Buffett and Berkshire Hathaway became the epic, legendary, it's a legend, right? Do you think Charlie Munger and Warren Buffett created their legend by buying at new highs? Is that, so there's so much to be said about, oh my gosh, Warren Buffett's got so much cash relative to what, right? He's got $300 billion in cash. It doesn't mean that he's thinking there's going to be a crash. I don't know what he's thinking. He's not going to tell us. Doesn't mean he's thinking there's going to be a crash. He just doesn't want to buy at new highs. And the fact that this seems to create so much consternation in the market just tells you how many momentum traders we have. Because when momentum traders see people not behaving like they want to behave, they freak out. They're selling more Apple. Look, how do you realize a profit aside from dividends and so forth? Look, do they want to buy Apple at highs? And look, anywhere between 220 and 240, these are significant highs in Apple, right? Will they buy at 200? Wouldn't be surprised. It just means they don't want to buy at new highs. And to the average retail trader, right, the top of their heads blow off because they can't imagine why someone's not doing the very thing that they spend all their time doing. So a lot of interesting chatter around this week, and especially with a week of FOMC and election. This Berkshire Hathaway narrative just won't go away. And it doesn't go look at how many times Berkshire Hathaway's not continued to buy, not done buybacks. I think I tweeted something. It's not as if the equity markets go down after that. It just means Warren and company don't want to buy at new highs because they're smart. Okay, gang, be good to each other. I'll talk with you soon.